Hello friends, I hope the market's treating you right and your understanding of the concept of cost of funds has improved significantly after you've read some of the works that I have shared of Stoken on a free file sharing website archives.org. The link is something I've shared on my social media accounts with you. Please do read those books if you haven't started yet. Now, in this video, I want to talk about the concept of cost of money, how this concept impacts the price discovery mechanism of your assets, whether it's stocks, whether it's bonds, it's your bullion, your house prices, your commercial property prices, the shirt that you're going to wear, and the food that you're going to eat. Everything depends on the cost of funds. If the cost of funds is going up, inflation will automatically follow. Now, I am reminded of the works of Sir John Templeton, the great late John Templeton. If you haven't read his book, The Templeton Way, please do read that book. Now, in that book, the first thing that will strike you is what Sir John Templeton said. He said, I would rather invest in an economy that rewards its savers rather than reward its borrowers. What did he mean? He meant savers are rewarded when interest rates are kept steady or are even raised, or at least they are higher than the real effective inflation adjusted rates. On the other hand, if the economy is constantly cutting rates because it wants to boost the GDP, it's a sign of distress. It's a sign that something is not right with the economy, and possibly asset prices are likely to stay under pressure. But we live in interesting times. I'm sure if Sir John Templeton were alive today, he would be flabbergasted to note how there is a race to the bottom and how everybody is devaluing their currency. This is something that we call currency wars, which has been in effect since September 2012, but that's the subject of another video, and how people are basically trying to cut interest rates so as to boost their sagging economies. Where is the world headed? We are now trying to boost up the economy by cutting interest rates so that people can borrow at lower interest rates on their credit cards from microfinance institutions and non-banking financial companies, in addition to banks, to spend on what they want to buy. Now that, at some level, might be jarring to us Indians who, conservatively brought up, have been told that saving is what saves you from a rainy day. Now, till the 1970s, the operation of currencies, fiat currencies, paper currencies, was fairly all right. But with the oil embargo starting after the Yom Kippur War of 1973, basically inflation went through the roof, and the US started to basically raise interest rates. They started doing a lot of magic with their currency. First of all, the currency that had already been taken off the gold standard meant that the US could print as many dollars as they wanted without the backing of gold. This is called unbacked currency. Austrian school of economics is slightly different from your conventional economics, and some of the best Austrian school economists include Friedrich Hayek. Now, he saw this coming. He said that fiat currencies will be debauched, which will be allowed to depreciate as their buying power is deliberately eroded so as to help people who don't have money to be able to spend money. But that will come at a cost. And sure enough, it was followed by another economist of note, Joseph Schumpeter, who came out with the theory of creative destruction, who also said that currency in its present form will lose its purchasing power, and therefore the cost of funds will actually be very high. You can, of course, feel free to disagree with any of my hypotheses, the comment segment is open to you for your feedback. Now that unbacked currency is unlikely to be printed anymore. Remember, at least 20 to 25% of all US dollars that are floating around in the public system, in the global markets today, have been printed after the COVID-based lockdown started in April 2020. That tells you just how much money the US has printed, and the US is not alone. All right. So now central bankers around the world cannot print unbacked currency without triggering hyperinflation, without pushing people out on the streets and taking out processions against inflation and the cost of living. If you have been observing what happened to Greece in 2012, you will know what I'm talking about. Millions of people came out in the streets complaining against inflation. That is not something that central bankers want, which is why unbacked currency is not really a viable option. What are the other options? Let's examine those. Option number one, continue to print currency but clamp down on the economy and regulate the prices of essentials. Say that you cannot sell this, and this product at prices higher than this, or this. This will be a muscular authoritarian state which will regulate a lot of essentials. But there is something called overreach. Will the state stop at regulating prices of essentials? Will the state be able to control the cost of funds because you're flooding the market with unbacked currency, which unfortunately over a period of time will lose its buying power, and therefore costs are going to go up irrespective of how much you regulate them? So that exactly doesn't seem very nice. The other thing is, go to the bond market. Borrow money from the check writer. Now, a slight clarification here. Who do I mean by the check writer? I keep mentioning the check writers in my social media writings, on my Telegram posts and WhatsApp channel posts, etc. By check writer, I mean the high net worth individual, the ultra high net worth individual who's saving so that he receives passive income called interest on his capital, so that he doesn't have to move a finger and work to earn his livelihood. Now, the check writer will basically ask for, and of late he is getting, higher rates of interest because the banks, and the central banks rather, have no option but to stop printing unbacked currency and borrow from the bond market. All right. Now, when you start approaching the check writer and tell him, hey, I need your money, write out a check to me, he's going to tell you, look, I want a higher rate of interest, otherwise I'm not writing the check. It's that simple as that. If you think it's the retail saver who's determining interest rates, all the best to you. You're wrong. Option number 3, cryptocurrencies. Bitcoin, Ethereum, Dogecoins, etc., etc. And hey, let's not forget CBDCs. What are CBDCs? Central banks' digital currencies. President-elect Donald Trump has already said, I will use Bitcoin to pay off the debt owed by the United States to its creditors. So Bitcoin has jumped high. Fair enough, you want to use Bitcoin as a currency, that's entirely up to you. But does cryptocurrency stand up as a good measure for an acceptable broad-based currency? Let's examine that. Any currency, by definition, should have 3 properties or 3 features to it. Number 1, uniform acceptability. It should be accepted everywhere in the country and even abroad. Maybe Bitcoin might just get acceptable at a later stage. I don't know. But till the time I go to the friendly neighborhood grocery store and say, hey, give me 6 eggs and a loaf of bread, and here I'm going to give you a fraction of a Bitcoin. Unless that happens, it's not yet a uniform currency as far as I am concerned. Maybe I can buy a Tesla with that, but that's where it stops. I need food more often than I need a Tesla. All right. Number 2, I need divisibility. What does divisibility mean? Divisibility mean whether you have a 100 rupee note or you have two 50 rupee notes, they should all be able to buy the same number of goods and services. So the value of two 50 rupee notes should not be less than 100 rupee note. That happens in diamonds. The bigger the diamond, the more expensive it is. If you cut a big diamond into two small halves, they don't command the same price together, sum of the parts valuation. All right. So Bitcoin and other cryptocurrencies are divisible. They are traded in fractions. So fine, let's give it the benefit of doubt on the first two counts. Universal acceptability, although it's not there yet, but let's say it's going to be, and divisibility. Number three, stability. Are they stable? Is my 500 rupee note stable? When I go to bed in the night, this 500 rupee note is still worth 500 rupees. Next morning, I'll still be able to buy some goods and services worth 500 rupees for that value. But are cryptocurrencies going to be the same? They are not. It's very possible that I go to bed being a millionaire holding X number of cryptocurrency and waking up in the morning and saying, okay, I exported goods and services worth so many million bitcoins, my remittance is due, and by the time it comes up, I'm hoping and praying that Bitcoin will be stable so that my remittance is actually resulting in a profit on that transaction. But lo and behold, Bitcoin falls, or any other cryptocurrency for that matter falls, and I've gone from a feast to a funeral. That trade which I took in the export market might just lose me so much money that I might have to declare bankruptcy. Believe me, it's not a very pleasant thought. In the year 2000, when the market collapsed in what is now known as the dot-com bust, I went to the brink of bankruptcy. It's not a very pleasant experience. The number of people that you have to tolerate just to stay alive to earn a few rupees is not funny at all. I don't want to go there anymore. Never again. So, as far as I'm concerned, cryptocurrencies are inflationary. Why? You see this? That's the serial number on this currency note. Although I will never know as an individual as to how many series of notes are printed, I at least go to the RBI's site and they tell me every quarter, every 6 months or every year as to how much is the currency in circulation. But if at all a CBDC or a central bank digital currency is brought in as legal tender means legal currency. How do I know how many of such these central bank digital currency coins have been minted? I don't know how many will be passed on as freebies to incentivize people. I don't know how much will be distributed by way of social welfare schemes, pre-election incentives, and therefore they can very well turn out to be inflationary again. So you've basically taken out printing currency and brought in CBDC, which is again running the risk of being minted without being backed by adequate assets. What do you do? So as far as I'm concerned, so far the middle path is the bond market. Now this is where the problem starts. Our financial education system has a few shortcomings, and I'm sorry to say that. We are taught that interest rates, if they are lowered, boost the economy and pump up the GDP. That's one side of the coin. Double entry system of account keeping tells us that debits must match the credits, otherwise the balance sheet and the trial balance will never tally. All right. So your textbooks tell you that lower interest rates boost the economy because borrowers can borrow cheaper and spend on goods and services with which they need to buy, so the economy gets stimulated. Fair enough, that's one aspect of it all. You forgot the check writer. He may not want to accept a lower rate of interest because the inflation adjusted interest rate might be actually zero or even negative, which is what been happening after the central bankers started cutting rates aggressively after 9/11 when those two aircrafts went and smashed into the World Trade Center Tower 1 and Tower 2. So when the depositor has been receiving negative interest rates, he starts to diversify his funds elsewhere, which explains to you why the stock market has boomed so much after 9/11. You needed money to be deployed elsewhere. It went from fixed income into stock markets and the stock market went up. But if the stock market stops rising, where does that money go? Do you think it will go to interest rate markets, the bond markets, when real effective interest rates are lower? The check writers are not going to write those checks. So then you cause liquidity problems in the banking system. Now go and ask, or go and Google search rather, if you don't want to ask, go and see why SBI, Bank of Baroda, Canara Bank, HDFC Bank are all raising interest rates and offering plum rates for you to give them fixed deposits. If at all interest rates are supposed to come down, which is what the general consensus of the experts is, why are these banks offering me higher rates? Just as a fair disclosure, I have not deployed money in the fixed income FD market as yet. Barring 1 lakh rupees, 100,000 in HDFC Bank just to basically oblige my relationship manager, I have given a 1 lakh rupee deposit. But I'm sitting on dry powder. As I have been telling you in my weekly videos, I have not yet invested in gilt funds. I have not yet bought the Indian 10-year sovereign benchmark bond. Again, no laddering has taken place and I have not put money in FDs. I'm waiting for higher rates of interest. Yes, color me funny if you want, have a good laugh, but I'm expecting rates to go up. So what is the impact of rising cost of funds? And are rising cost of funds the same as interest rates? First of all, cost of funds and interest rate need not be the same. Bear with me, I'm going to explain to you why. This is not something that any college teacher will be able to explain to you, because I'm sorry, they haven't been taught that too. Alright, so we know that the real effective cost of money is going to go up. How does it impact you? Number one, interest rate sensitive stocks will be the first to react. Do remember that money is either the raw material and or the finished products for them. Especially for banks, the money is actually the raw material because it borrows from the depositor, and it's the finished product because it then sells or lends to a borrower. NBFCs, which borrow money from banks and lend it to the other guys. Companies that are basically financing consumer goods, white goods, automobiles, your washing machine, refrigerators, etc., etc. These are consumer finance companies, also NBFCs. They will be impacted negatively. The other thing is companies that depend heavily on EMI based selling. Think of how many things primarily sell on EMIs rather than being sold on down payments. Look at the stock prices of those companies where sales are more than 80-90% on EMIs and see what's happened to them after the election results were out on 4th of June. I'm not saying anything political about the election result period. I'm saying it because it's been 20 weeks. It's been 5 months out here. So 20 is a period, a 20-day moving average, a 20-week moving average, a 20-month moving average is extremely critical for technical analysts. Now, these are certain sectors which are going to feel the heat. Now, you ask me, Vijay, why haven't banking stocks fallen as yet? They are interest rate sensitive. Fair enough. Very good question. But I'll tell you why. Banking and financial sector stocks command a 34.25% weightage in the Nifty. If at all you want to push the market higher, which is what big money has been doing, you cannot have a rally in the market unless you push banking and financial sector stocks higher in India, because 34% of the entire weightage is of this sector. Now think of it on the flip side. So far, this sector has been holding firm. What if this sector starts to lose in price, in value? that's when you know there could be some challenge for you and your investment portfolio, because it will drag the broader markets with itself. So if you think cost of funds does not materially impact the way you invest, the way you trade, I'm sorry, I don't have anything else to convince you with. Now, low cost money is like mother's milk for a bull market. In the financial markets, as long as you have ample amounts of money flooding the markets, you will have asset prices climbing higher. I remember, not without ample amount of laughter, as to how for almost 3.5 years now, I have been debunking the super cycle theory in the commodity markets. Sure enough, I've got trolled by many guys who up to last year were basically telling me, hey, look how this is going up. Hey, look how copper is going up. Hey, look, crude oil prices are down. But see where they are. Those stories about $200, $250, $300 to a barrel of crude, all out. Natural gas went up due to the Ukraine war, and then there were stories about $20 per MMBTU, $25 per MMBTU. And I would go, what? Are these guys really serious right now? What are they smoking? What are they snorting? What are they drinking? Right? Do you remember how prices of lumber, chopped wood, went up 600% during COVID? It was like man had exported all the trees from Earth to Mars. Now, this is what happens when irrational exuberance and common sense goes out of the window. But cost of funds basically started escalating from October 2021, and I started putting up posts on my social media. Like you can see on your screen right now, it's time to ladder fixed income. And I've been doing that myself. No regrets whatsoever. Those super cycle calls on copper, on crude oil, on natural gas, on base metals, etc. are falling flat because cost of funds is going up. And commodities are extremely sensitive. I would go out and say radar sensitive to cost of funds. And higher cost of funds is pressing prices lower. Now, what is the difference between cost of funds and interest rates? Let me explain to you. If at all, interest rates are cut by the banks. They announce a 0.5% cut in interest rates. What really happens? The first thing that will happen is you and I as depositors, like I told you, I only have 100,000 rupees as a fixed deposit. I don't really deploy money in FDs at this point in time at these rates. But what will happen to you and me is immediately our rate of interest will be cut. Of course, the money that you've already deployed at the contracted levels will still attract the same interest rate. But if you were to go and deposit fresh money, you would get a lower interest rate. That's for depositors. But do you think the borrower will be able to get money at that 0.5% reduced rate of interest? Not happening. Why? Because what will be cut is the PLR, the prime lending rate. Now, this is the rate at which AAA plus borrowers get to borrow money. Try as you might, you will not be a AAA plus client as a borrower. AAA plus guys don't need to borrow in the first place. So you won't get money at that price. What you will get is a higher coupon rate. So what will happen is that the rate will be cut, all right, for depositors, but you will not be able to borrow money at that rate. If at all, there is a pass-through, the trickle-down effect. So 0.5% rate is cut, and to the borrower, they might say, okay, we are going to cut 0.25% interest rates for you because we need to have you benefit from it. But you know what will happen? There will be other charges. Documentation charges, loan processing charges, loan appraisal charges, legal fees. Believe me when I tell you this, your actual total cost of borrowing will be up. So your cost of funds is going to go up. You can blame the check writer all you want. It's fashionable to say, okay, these rich guys, they are the scum of the earth and they are the root cause of all the problems and they've taken away all our money. But the fact is that there are two sides of the coin. One is a check writer, the other is a borrower, and both need each other. There needs to be a balance, an equilibrium at which both are able to coexist and help each other. The borrower should be able to get low cost funds, and the saver should be able to get inflation plus some more amount of money to be able to stay alive. This is what was Sir John Templeton's idea in the book The Templeton Way, and this is what he said: I would like to invest in those countries which are helping and rewarding the saver rather than the borrower, which tells me that the economy is fairly healthy. Now, for further details, I would very strongly urge you to read Dick Stoken's books. I see at least 3 of them on archive.org in the hyperlink that I shared with you. And if you still don't understand the cost of funds, and if you're still lazy and ignore it, I'm sorry, but you're the equivalent of a guy living in a cave, and you'll be redundant sooner rather than later. I hope this video has clarified the point of view of why cost of money is likely to go up. Interest rates might come down, but cost of funds will go up real effective basis. These are not exactly very easy times to trade or invest in the market. So skill up and take your understanding of the market to the next level to be able to survive and thrive in the current market scenarios. Friends, before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos help you become a better trader. And please share my video with family and friends and smart traders like yourselves, so to help me reach out to a wider audience. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable trade ahead. Take care. Bye-bye.